Amazon is staring down one of the most complex macro storms it's faced in years. Tariffs, logistics, demand uncertainty, and massive pressure on margins. But how bad could it get? Well, today we're diving into 6 major risk factors that are driving investor uncertainty, and why, even with a 10% cut to earnings, Amazon may still be undervalued. Let's break this down. First off, the big picture. Despite a volatile environment, we're sticking with an overweight rating on Amazon. But we've cut our 2026 EPS forecast by 10% to $7, and revised our 12-month price target to $245, still offering about 30% upside from current levels. But here's the catch. It could take several quarters, maybe more, before investors feel confident about Amazon's 2H 2025 and 2026 earnings trajectory. There are simply too many moving parts. So let's go factor by factor. Factor 1. GMV growth slowdown. We're moderating our GMV estimates as demand softens and price sensitivity rises. Lower volumes plus price ceiling constraints equals tougher comps for Amazon retail. Factor 2 to 1P tariffs. This is the big one. The April 2nd announcement by Trump brought back high-stakes tariff math, with a weighted average 18.2% rate, 10% baseline, up to 46% for some countries like Vietnam. What does that mean for Amazon? Well, for its 1P, first-party, US e-commerce business, we estimate that about 74% of 1P sales go to merchandise cost, 60% of that comes from the US, and 35% of those US merchandise costs come from China, with a 34% tariff on Chinese imports and 10% on others. Our modeling suggests a 15-20% increase in 1P merchandise costs, if Amazon absorbs 100% of it. But that's not likely. Amazon has options. It can negotiate with suppliers, shift product mix away from heavily tariffed items, and, yes, raise prices on consumers. Here's the math. At a 26% merchandise margin, a 20% cost increase would require a 15% price increase to offset. And that's exactly the kind of lever Amazon has used before, like it did in 2018-2019, when tariffs were first implemented under Trump. Back then, margins held steady. Factor 3 to 3P tariff. Now, while Amazon doesn't directly absorb costs for 3P sellers, those sellers may raise prices, which impacts overall GMV and fee income. Interestingly, this weekend's tariff exemptions on electronics could ease some 3P pressure. But it's a fluid situation, and competitive dynamics with players like Temu and TikTok Shop are rapidly shifting, especially now that de minimis exemptions are closing. That could reduce China-based exporter pressure, but also reshuffle pricing structures across the platform. Factor 4. Advertising sensitivity. Amazon's ad business, a key profit driver, is partially exposed to consumer and seller sentiment. If unit sales decline or 3P sellers pull back on spend due to tariff pass-through, ad growth could decelerate, especially in retail-linked categories. Factor 5. Logistics and cost deleverage. Let's face it, matching supply to demand in a volatile environment is expensive. More low-margin deliveries, regional mismatches, and faster shipping requirements can drive logistics costs higher. If volumes drop, we lose scale. And when that happens, fixed costs bite harder. Factor 6. AWS and CapEx. Finally, Oz. While hyperscaler demand remains strong, enterprise spending is uneven, and geopolitical risk is rising. Export controls, data localization laws, and macro headwinds could affect AWS growth, credits, or optimization usage. CapEx plans are still aggressive, but some ROI timelines may extend if top-line pressure builds. So, how bad is it? In our most severe scenario, the bear case, we see a $150 stock price, about 20% downside, based on EPS of $6, 24x forward multiple, further macro deterioration, tariff costs not being mitigated, and rising investment to maintain growth. But that's the worst case. Even in our base case, tariff impacts could trim $10 billion from EBIT annually, if no mitigation is in place. Here's the good news. Amazon has done this before. In 2018-2019, with Trump's original tariffs, worldwide merchandise margins stayed stable. They negotiated. They repriced. They adapted. This time, it's more complex. But the tools remain. Now, let's look at what makes this so tricky. We don't know how much of the tariff will be passed on by suppliers. We don't know how consumers will react to price increases, and we don't know how much elasticity Amazon has left in its system. We ran scenarios where costs rise by 10%, prices go up by 5 to 7%, and unit sales fall by up to 20% in a severe case. The result? Margins get squeezed, but not broken. And as long as AWS keeps growing and ad revenue stays resilient, Amazon's total business has the diversification to absorb the shock. So where does this leave us? Amazon trades at 35x, 26x, 29x, 27x, a 20 to 30% discount to peers on a growth-adjusted basis. That's compelling, if you can weather the storm. Let us know what you think. Are tariffs a temporary headwind or a structural drag? Will Amazon successfully negotiate its way through? Or is this the moment investors should brace for a multiple reset? Comment below, like if this helped clarify the numbers, and subscribe for more deep dives on megacap tech, macro, and market strategy. Because Amazon's not just an e-commerce company. It's a system, and the system is adapting.